Now it's my honor to introduce the Consumer Financial Protection Bureau Director, Rohit Chopra. He was confirmed by the Senate on September 30th, 2021, almost exactly 2 years ago. As director, he also serves as a member of the Financial Stability Oversight Council, FSOC, and as a member of the FDIC board. As a result, he has a 360-degree view of all the key consumer, banking, and financial stability issues facing the country. Uniquely, his purview is not siloed by the type or form of financial institution or activity. It spans banks and non-banks alike. His job is to protect financial consumers, regardless of where the threats, dangers, or illegal conduct come from. Prior to becoming the CFPB director, he served as the commissioner of the Federal Trade Commission, or FTC, for almost 3 years, where, among other things, he focused on repeat offenders, protecting small businesses, and promoting competition. And before that, he was an assistant director at the CFPB, where he worked to actually stand up the Bureau during its first 5 years, from about 2010 to 2015. And he served as the agency's student loan ombudsman. Few people have arrived at their job with as much experience or better prepared than Director Chopra. And the result has been that I doubt anybody has accomplished as much in 2 years as he has with the fantastic team he has put together. Director Chopra is going to discuss Too Big to Fail from a financial consumer protection point of view. Then we're going to ask him a few questions. And now I'd like to welcome Director Chopra.
Well, thanks, Dennis, and thanks to Better Markets for inviting me to speak today. It's really good to be with you. 15 years ago in mid-September, Lehman Brothers collapsed and the financial system crashed, and troubles in the mortgage market infected the entire globe. And American families and businesses lost trillions of dollars and experienced an incalculable level of pain. The story is not just one of an out-of-control financial industry, but it's also a story about a series of the worst failures by regulators in modern history. This anniversary is not a celebration, but a moment to reflect. So today, I want to first dive a little deeper into the collapse of Lehman Brothers from a consumer perspective, and then I want to share a few details on the reforms put in place after the crisis, including the establishment of the CFPB, and how consumer protection is more than its name suggests. It is, in fact, a pillar of financial stability. I highlight the fact that by discussing how the consumer protection reforms may have been able to prevent much of what tipped the globe into the Great Recession. I'll then share some other lessons from the crisis that continue to guide us today. And I'll finish by discussing some of the unfinished business and major threats, including the upcoming Supreme Court case involving the CFPB. My views are just mine and the CFPB's and do not necessarily reflect other parts of our regulators, the FDIC board, Federal Reserve System, and other legal disclaimers. So the story of Lehman often sounds complicated, but at its core, it's a story about one of the financial products that literally hits closest to home, residential mortgages. For a long time, Lehman, like other Wall Street firms, had a profitable business in buying up mortgages and reselling them on the secondary market. In 1997, the company became one of the first firms to move from just buying and selling mortgages to originating them. And they moved into the subprime origination market with their purchase of BNC Mortgage, a non-bank lender, in 2000. Now, Lehman blew up in spectacular fashion for many reasons, but I want to highlight just a couple that are important today. First, it relied heavily on short-term of an overnight funding that looked a lot like deposits that banks fund themselves with. But these deposits didn't have deposit insurance, access to the Fed's lending system, or the safeguards that come with being a chartered bank. Instead, Lehman operated like this. Imagine taking out a mortgage out on your house every morning with the expectation you would pay it off by midnight every single day. That's what Lehman was doing to stay afloat. And then second, the firm relied excessively on borrowed money and didn't have much of its own skin in the game. In November 2007, for every dollar of its own money available to absorb losses, it had borrowed 30. Finally, it originated, packaged, distributed, and also held highly risky subprime mortgages that inevitably nosedived in value. Within Lehman's origination business, there was very little concern given the homeowner's ability to repay, almost no concern given to the day those owners could no longer meet monthly payments, and little concern given to the pensioners and retirees whose plan managers had been led to believe these securitized and bundled mortgages were safe investments. As one of Lehman's own lawyers put it, we simply, quote, expected the Fed to save Lehman. And as Lehman Brothers CEO at the time of the collapse, Dick Fuld said, quote, until the day they put me in the ground, I will wonder why the federal government didn't bail us out. Under such a belief system, there was no need to worry so much about risk management or to take the voluntary regulation system that existed at the time seriously. Lehman's bankruptcy was a watershed moment as public confidence evaporated, markets plunged, and other firms fell like dominoes. One of the key lessons learned from the crisis was how consumer protection is foundational for financial stability. Those consumer abuses played a starring role, and there was really no agency accountable for dealing with it. And it was that lack of focus that enabled Wall Street's shadow firms, banks, and independent lenders to undermine our country's mortgage system. It is safe to say that it was the failure of consumer protection safeguards that really contributed to the collapse of the US financial system and the entire economy. Lenders were able to approve mortgages for families that they either knew could not repay them or could just take a mortgage broker's word that the homeowner would repay. Those actions really formed the base of the crisis. From there, financial institutions were able to make, buy, and sell securities they never really examined for quality or ability to repay. Oftentimes, they knew they were trading in junk securities, but they knew investors would just blindly listen to the rating agencies that were not also concerned about the actual calculations of risk. It can be easy to fall into the trap of thinking the CFPB only matters for the family that could lose their home or the person getting their car repossessed or a student taking out a loan for college. But the consumer financial protection laws enforced by the CFPB serve as catalysts for long-term economic growth and stability, and really to protect against buildups of systemic risk. That's why the CFPB is really not just looking out for consumers, but ensuring that all of those risks don't spread and infect the rest of the economy. Now, briefly back to Lehman. A Lehman of today would face a series of reforms mandated by Congress and implemented by the CFPB. Importantly, its non-bank mortgage subsidiaries would need to operate under the same strengthened mortgage rules as chartered banks and credit unions. And one of those reforms was a ban on mortgages where the lender didn't assess the borrower's ability to repay. The CFPB implemented a set of standards that mortgage lenders follow to stay in compliance with this prohibition. And given that some lenders used to be able to profit even when setting borrowers up to fail, this would reduce defaults in the entire system. A CFPB assessment of the qualified mortgage and ability to repay rule found approximately 50 to 60% of mortgages originated between 2005 and 2007 that experienced foreclosure in the first 2 years after origination were mortgage loans with features that the rule would have restricted, eliminated, or otherwise excluded from the definition of a qualified mortgage. In other words, most of the mortgages that comprised the base of the 2008 crisis would have never been approved. And in addition, banks and non-banks alike of today that acted like Lehman would be subject to state action. Many state regulators and attorneys general had been sounding the alarm for years and years preceding the 2008 financial crisis, but were consistently encountering obstacles. One of them was by the Office of the Comptroller of the Currency. Not only did the OCC fail to take appropriate action at the federal level to check egregious risk-taking, it even went so far as to hit delete on state laws designed to protect residents from dangerous mortgages using the OCC's abusive preemption policy, and Congress put a stop to that. The Financial Crisis Inquiry Commission revealed how some other regulators, like the Office of Thrift Supervision, engaged in race to the bottom regulation, marketing its lax oversight as a feature to attract more fees. This clientele theory of regulation didn't end well, and by November of 2008, the FDIC would seize 3 of OTS's banks, and 3 banks more would sell themselves to avoid failure and seizure. And some of these failures were the most expensive failures in the FDIC's history. Postmortems of the crisis also revealed how the Federal Reserve Board of Governors failed to use its own tools to stem the flow of toxic mortgages. It just acted too little and too late. All of this was allowed to happen because consumer protection was not really considered a pillar of stability and financial stability. And the results of that choice are stark. 2.3 million properties into foreclosure in each year between 2008 and 2010. And the Great Recession ended up costing, on average, every single American $70,000 in present value lifetime income. Better Market's own analysis found that 4 years removed from the 2008 crisis, there was an excess of 12.5 million people out of work, and there are 46.2 million people in poverty, the highest number from the previous 50 years. And many of us know that if the CFPB had existed 2 decades ago, and especially those important mortgage rules, the factors that led to the Great Recession would have been mitigated early on. Now, I've discussed how the CFPB has changed the regulatory system, but I also want to mention a couple of other areas where more must be done to make the words in the financial reforms of 2010 a reality. First is open banking and personal financial data rights. A key priority for the CFPB is to help the US accelerate the shift to open banking and payments in our increasingly digital world. Over time, this can help people get paid faster, access more attractive rates on deposits and loans, switch more easily, avoid intrusive surveillance, and minimize the consequences of inaccurate credit reporting. This can also create a more resilient and dynamic financial system. We'll be proposing rules next month to implement a dormant authority under Section 1033 of the Act to advance these goals. And second, amid yet another series of emergency bank mergers, the biggest financial firms have gotten even bigger. An important part of the financial crisis response was the 2010 changes to the Bank Merger Act that required regulators to conduct a financial stability analysis when assessing a merger. And after collecting comment and assessing current practices by the agencies and the Justice Department, it's clear that the review process was a double whammy of dysfunction, failing on analytical rigor and failing on process. Expect more on this front so that we can ensure merger review respects the law and is grounded in reality. Third, we need to ensure that the so-called living wills of large financial firms are more than just fairy tales. After the experience with Silicon Valley, Signature, and First Republic, banks that are just a tiny fraction of the size of the biggest global giants, many experts continue to question whether large financial firms can go through the bankruptcy process without creating chaos in the markets or requiring a string of bailouts. The experience with the government-facilitated Credit Suisse UBS merger recently, unfortunately, provides more evidence of this concern. Fourth, too big to fail shadow banks did not magically disappear after the collapse of Lehman Brothers. Yet there is not a single shadow bank today that faces the enhanced safeguards envisioned by the reforms, which are supposed to work complementary to the stronger consumer rules. It's important that the Financial Stability Oversight Council has credibility, and stands as a strong bulwark against threats to the financial system. The Council is currently reviewing comments on a proposal to reinvigorate the designation authority. Fifth, uninsured short-term funding instruments outside the banking system that look and feel like deposits often fuel shadow banks and make them risky to consumers. The law provides the authority to place stronger protections on risky payment, clearing, and settlement activities, and we've got to carefully review how we address those risks, especially as uninsured balances on payment apps and coins minted by big tech and other firms, and as well as emerging pockets of short-term funding. And there's a long list more. But right now, I wanted to share one other piece. As many of you are aware, the CFPB is facing a challenge, a constitutional challenge. And in a few weeks, the Supreme Court will hear a case reviewing a decision from the Fifth Circuit Court of Appeals. And the stakes are big. Vacating or calling into question the CFPB's actions, especially as it relates to mortgage reforms, could be destabilizing. And so much of the implementation of the Truth in Lending Act, the Fair Credit Reporting Act, the Electronic Fund Transfer Act, these are rules that affect the way millions of people borrow and send trillions of dollars. Uncertainty could have real consequences. And the rules administered by other regulators with similar funding structures could just add more questions about those rules and the ability of markets to adapt to future challenges. So that's why we have a lot more that we have to do to not just protect the CFPB, but to keep it going. If the past 15 years have taught us anything, it's that the stakes of our financial system, economy, and society are too high for consumer financial protection to recede into the background. And the recent bank failures demonstrated that financial executives can continue to place bad bets where the public has to clean up the mess. And we know financial markets need enforceable, bright lines, and consumers need to know there's someone there looking for them. And despite the threats to the CFPB, we're continuing to do a lot of work, getting back billions of dollars for harmed consumers and making sure the markets are working. So thank you. And Dennis, I look forward to our conversation.
Great. Thank you for those remarks. Really interesting, especially spelling out how financial or consumer protection is foundational for financial stability. I think a lot of people don't really understand that. And for talking about the reforms the CFPB and others have put in place that strengthen consumer protection and at the same time financial stability. One of the things that's clear to me, evidencing the change from before the CFPB to after the CFPB, is the interactions with the states. And one of the signal achievements, I think, that has happened is the partnership developed with the states. So before the crash, the federal regulators stomped on the states, prevented them from enforcing their own laws, and then didn't enforce the laws themselves. And yet I find it really interesting how often you, a federal regulator, work with the states. In fact, just earlier this week, I saw that the CFPB and 41 states in the District of Columbia took action against a company called Tempo, a leasing company that was ripping off customers when they were seeking just to finance their purchases at Sears and Kmart. And I think it's noteworthy that action, like so many others, include so-called red states like Texas, West Virginia, and North Dakota, as well as blue states like Massachusetts, Minnesota, and New York. And I think that highlights a sea change in the way federal consumer protection regulation works with the states. And I wondered if you would talk a little bit about your work with the states in protecting consumers and why that's important.
Well, really, when it comes to state regulators, state banking commissioners, state AGs, I really see this as an all hands on deck approach, and that no one has a monopoly on consumer protection. And let me explain to you why, Dennis, it's especially important. I think some of the lessons from the financial crisis, many states did actually put into place some restrictions on the worst abuses when it came to mortgage lending, and they found themselves hearing from the Office of the Comptroller of the Currency, a regulator that was basically saying that many banks didn't have to follow those laws. Congress essentially banned that practice. And now preemption or hitting delete on those state laws is much narrower. But the other part, Dennis, that's so important is that states actually can enforce the Consumer Financial Protection Act. It gives them the ability to directly go to court to stop some of these abuses. So that means if the CFPB is asleep at the switch, it won't be catastrophic because there will be others who can fill in those gaps. It also sends a message to financial firms that even if they are able to convince the CFPB to turn a blind eye, that there will be others who may go and make sure they're held accountable.
Yeah, that's incredibly important, and I think overlooked the limitations that were put in the Dodd-Frank Act on the feds to use preemption to stop the states from protecting their own people. And the Secretary of State in Massachusetts, Bill Galvin, just used some of those authorities in connection with the fiduciary duty, was upheld by the Massachusetts Supreme Court, and a perfect example of how you show working with the states works, but when the feds don't work, the states can still step in and protect their citizens. I wanted to talk about the CFPB's record and enforcement priorities for a minute. By my count, in the last 3 years, the Bureau has ordered almost $3 billion in redress or restitution for millions of ripped off American consumers. And that's making companies put money back into consumers' pocketbooks and wallets on top of the $2 billion in civil fines the Bureau has imposed. And, that's been for everything from, abusive debt collection practices, fraudulent auto loans, mortgage ripoffs, student lendings, and much more. I think it's interesting. They're not just small and fly-by-night operators that the CFPB is dealing with here. It's some of the biggest corporations in the country, like Nissan Motors and Hyundai, as well as Bank of America, Regions Bank, Wells Fargo, and others. So would you talk a little bit about the Bureau's enforcement program and its priorities, including in particular the importance of restitution, dealing with repeat offenders, and holding executives accountable?
Well, this is important because I think we are now at the moment where we know that there are so many billions of dollars that would otherwise not be in individual families' hands. We are sending checks or getting account credits on so many different cases, but also through our other work, examining those institutions that leads to redress and more. Now, I want to spend a minute just on the issue of repeat offenders. I think a lot of Americans are getting numb to the fact that they keep hearing about these settlements with the same firm over and over and over again. And I think the recipe for addressing those repeat offenses just isn't working. So we are starting to move in different directions, and we've set up a repeat offenders unit. And you're right, we got to look at what is really some of those incentives about whether they're going to break the law again. Growth restrictions, bans on certain business practices, and importantly, individual accountability. In some of our cases, we have named top-level executives, including of some of the most well-known players in the industry. We've received some favorable court rulings on that front, but often litigation continues on and on. But I do think that we've got to identify the specific folks sometimes that called the shots, and expect to see more of that on our side. I'll also say, we also want a world where things don't have to go to law enforcement, that they follow the law in the first place. But of course, we know that the temptations and the big money can often lead to breaking the law, and that's what we're there for.
Yeah, that's great to hear. I know you're not limited to banks, but I've been saying for years that banks and buildings don't break the law, bankers and people do. And until bankers and people are meaningfully and personally punished, you're not going to get banks or non-banks to follow the law. And so not only is it important that individual executives and officers get punished, but repeat offenders get punished most importantly of all, or we're just never going to get there. I wanted to turn for a minute to too big to fail. And I see too big to fail in bailouts for the biggest financial firms in the U.S. as kind of a deeply unfair and anti-competitive practice. And when those firms fail, like Lehman and the rest of them did in 2008, they don't go bankrupt like any other company in the United States. Instead, they get bailed out by the government and taxpayers. And I see this fundamentally unfair. As a director at the FDIC, you recently voted in favor of proposing a rule that, among other things, would require resolution plans for banks that are so large that they're systemically significant. And that means that their failure could threaten the financial system and economy, which, people don't realize. We've got about 4,700 banks in the United States, but only about 30 of them are so big that they're systemically significant. But the proposal on resolution plans, often called living wills, are supposed to enable them to be resolved in an orderly way, ideally in bankruptcy. And you mentioned this in passing earlier, but I wondered if you'd talk for a minute about why you think living wills for those handful of giant banks is so important.
Well, I think you raised there is this unjust piece of this, which is, why is it that when a small firm goes down, they face a lot of consequences. And frankly, when a small company in general breaks the law, I feel like federal regulators are really quick to lay the hammer on them. But it just appears that there's a different set of rules for the largest ones. And we have to make sure that there really is a level competitive playing field on that. So here's really what we're proposing. What we're proposing is that those firms, and we had a number of them just this past March that most members of the public had never heard of them before, but it led to emergency interventions to stop it from infecting the financial system. We now have a bunch of those. And so what we want to do is to make sure that there's some plans that if they go down, is there an alternative? And what are the alternatives of dealing with them rather than just being forced to bail them out or to sell them to one of the largest Wall Street giants? Are there ways that we can prevent their failure? And if they do fail, what is the ways to stop the catastrophe and the consequences? So we're going through that process. We've seen firsthand 6 months ago of them failing and dominoes toppling. And that's exactly what we want to stop.
Yeah. I see resolution plans or living wills as anti-bailout plans. So let's hope that gets to a speedy resolution and the rules get in place. I know we don't have much time left, but I would be remiss not to return to a subject that you mentioned, and that is the existential threat to the CFPB with the pending Supreme Court case. I don't think a lot of people have any understanding, and of course, legal cases are complex and the Supreme Court is difficult to understand for most people. But this is a case that may wreak havoc, not just with the CFPB, but it's going to take the consumer cop, the CFPB, off the beat. And it may well wreak havoc in the mortgage markets, in the financial markets, and other parts of our economy. So I'd like to end with asking you to talk a little bit more about that so that people have a better understanding of exactly what kind of a threat that this particular legal case poses. And it's going to happen soon. I think the argument's on October 5th, and it's expected that in the months thereafter, the Supreme Court will rule.
Yeah, a payday loan coalition has alleged that the CFPB's funding, which is the same as the Federal Reserve's funding, is unconstitutional. And so the Solicitor General is representing the CFPB in this matter. We've put forth our brief to the Supreme Court. I won't really comment in detail on the case, but we know that it's already inviting questions, especially from the mortgage industry, on what happens if all these rules that the entire housing finance system relies on are somehow called into question. Will there be years and years of uncertainty and litigation? And Dennis, I think you're also hearing others who are saying, we've had a system, Congress has designed the banking regulators, financial regulators, to have independent funding, and Congress spells it out. And that's happened since just around the time of the Civil War. So what are the implications for not just the CFPB, but all of these financial regulators and the Federal Reserve Board when it comes to these types of attacks? So we're still doing our job, we're still delivering results, but I don't think a lot of financial executives are really wondering whether this gambit to kind of tear down the CFPB is really what's good for business or what's good for the economy.
Yeah, well, that's a good point, because not only isn't it good for consumers, it's not good for business, the financial system of the economy. And you probably didn't get a chance to see it with everything you've got to do, but several of the experts earlier in the conference talked quite passionately about this case and the importance of the CFPB winning this case, because that's not a win for the CFPB, it's a win for the American people. And they are lucky to have such an effective consumer cop on the beat. And they're lucky to have you as the director. We appreciate your time. We appreciate your thoughts. Thanks for coming on. We really enjoyed it.
Well, thanks so much, Dennis. And thanks to all of you as we really reflect 15 years later and what we do to make sure something like that never happens again.
Thank you. We're going to go to a quick coffee break, and then we'll reconvene with our next panel. Stay tuned.